Shringar Limited is a company dedicated to the art of designing and manufacturing Mangalsutras in India. Their designs feature a variety of stones, including American diamonds, cubic zirconia, pearls, and semi-precious stones, all set in high-quality 18-karat and 22-karat gold. The IPO is an entirely fresh issue, with a total issue size of around 401 crore rupees. Now let's see the conservative case. In this conservative case discounted cash flow valuation, I have assumed that revenues will grow at a steady rate of 10% each year. At the same time, the EBITDA margin, which begins at 6.5%, is expected to gradually decline to 5% over the projection period. This assumption reflects a cautious outlook, factoring in rising costs or potential competitive pressure on profitability. Revenues start at around 1,573 crore in year 1 and increase steadily, crossing 3,700 crore by year 10 and reaching close to 3,932 crore in the terminal year. After subtracting cost of goods sold, depreciation, and other adjustments, EBIT is about 99 crore in the first year and rises consistently to 217 crore by year 10, before normalizing at nearly 191 crore in the terminal year. Once taxes are applied, EBIT after tax is approximately 75 crore in year 1, increasing gradually to 164 crore by year 10. When we add back depreciation and adjust for capital expenditure and working capital changes, the free cash flow to the firm comes into focus. In this conservative case, free cash flow shows fluctuations in the early years due to reinvestments and higher working capital needs. It begins at about 132 crore in year 1, dips to 53 crore in year 4, and then grows sharply to 226 crore by year 10, while the terminal year stabilizes at around 180 crore. After discounting, the present value of cash flows ranges from nearly 120 crore in year 1 to around 87 crore in the later years, with variations along the way due to reinvestment patterns. Overall, this conservative case DCF highlights that even with lower margin assumptions and a cautious growth outlook, the company is still projected to generate healthy and rising free cash flows over the long term. Based on the conservative case discounted cash flow analysis, the present value of free cash flows in the high growth phase comes out to around 800 crore, while the present value of the terminal value of the firm is approximately 2,021 crore. This gives us the total value of the firm. From this, we adjust for the market value of debt, which is about 123 crore, to arrive at the market value of equity at roughly 2,698 crore. Adding cash and cash equivalents along with IPO proceeds of around 403 crore, the total value of equity in common stock works out to nearly 3,101 crore. With total outstanding shares of about 9.6 crore, the intrinsic value per share is estimated at approximately 323. When compared to the listing upper band price of 165, the intrinsic value appears significantly higher. However, this analysis is purely based on conservative assumptions and valuation methods. This is not a recommendation to buy or sell. Now let's see the base case. In this base case discounted cash flow analysis, I have projected revenues to grow at a healthy rate of 15% annually. Alongside this growth, the EBITDA margin is assumed to improve gradually, rising from 6.5% in the initial years to 9% by the end of the projection period. This represents a more optimistic view compared to the conservative case, as it factors in operational efficiency and better cost management over time. Revenues start at around 1,645 crore in year 1 and steadily increase each year, crossing 5,000 crore by year 9 and reaching nearly 6,133 crore in the terminal year. After deducting cost of goods sold, depreciation, and other expenses, EBIT begins at approximately 104 crore in the first year and grows consistently, reaching 515 crore by year 10 and nearly 546 crore in the terminal year. When taxes are applied, EBIT after tax rises from about 79 crore in year 1 to almost 389 crore by year 10, with the terminal year figure close to 412 crore. Adding back depreciation and adjusting for capital spending and changes in working capital, we arrive at the free cash flow to the firm. In this base case scenario, free cash flows begin at around 164 crore in year 1, rise steadily with business growth, and reach more than 534 crore by year 10. The terminal year free cash flow stands at approximately 467 crore. All these cash flows are discounted at 10.8%, which I have taken as the cost of capital. After discounting, the present value of cash flows is about 148 crore in year 1, moves between 66 and 198 crore during the projection period, and reflects the compounding effect of higher revenues and stronger margins in later years. Based on the base case discounted cash flow analysis, the present value of free cash flows during the high growth phase is estimated at around 1,415 crore. The present value of the terminal value of the firm is about 5,025 crore, taking the total firm value significantly higher. After adjusting for the market value of debt of approximately 123 crore, the market value of equity stands at nearly 6,318 crore. Adding cash and cash equivalents along with IPO proceeds of about 403 crore, the total value of equity in common stock comes to around 6,721 crore. With a total of 9.6 crore outstanding shares, the intrinsic value per share works out to approximately 700 rupees. Now let's see the optimistic case. In this optimistic case discounted cash flow analysis, revenues are projected to grow at a strong pace of 20% annually. At the same time, the EBITDA margin is assumed to expand from 6.5% in the initial years to 12% by the end of the projection period. This scenario reflects a highly positive outlook, assuming both aggressive top-line growth and significant operational efficiency gains. Revenues begin at around 1,716 crore in year 1 and grow rapidly, crossing 7,000 crore by year 9 and reaching nearly 9,385 crore in the terminal year. After deducting cost of goods sold and depreciation, EBIT starts at approximately 109 crore in the first year and climbs sharply, touching 1,039 crore in year 10 and around 1,120 crore in the terminal year. When we account for taxes, EBIT after tax rises from nearly 82 crore in year 1 to about 784 crore by year 10, with the terminal year figure close to 846 crore. Adding back depreciation and adjusting for capital expenditure and changes in working capital, the free cash flow to the firm shows a strong upward trajectory. It begins at around 137 crore in year 1, grows steadily to 909 crore by year 10, and stabilizes at about 926 crore in the terminal year. When discounted at a cost of capital of 10.8%, the present value of cash flows starts at nearly 125 crore in year 1, rises over time, and reaches as high as 352 crore in year 10, with significant contributions from the later years due to rapid growth and higher profitability. The present value of free cash flows during the high growth phase works out to around 2,026 crore, while the present value of the terminal value of the firm is approximately 10,378 crore. Together, this gives us the total value of the firm. After adjusting for the market value of debt of about 123 crore, the market value of equity stands at nearly 12,281 crore. When we add cash and cash equivalents along with IPO proceeds of around 403 crore, the total value of equity in common stock comes to approximately 12,684 crore. With total outstanding shares of 9.6 crore, the intrinsic value per share is estimated at about 1,321. In our valuation analysis, we looked at the company under 3 different scenarios: conservative, base case, and optimistic. In all 3 scenarios, the calculated intrinsic value is significantly higher than the IPO upper band price of 165. However, it is important to note that this entire analysis is based on multiple assumptions regarding growth, margins, reinvestments, and discount rates. These analysis is for educational purpose and should not be taken as investment advice. This is not a recommendation to buy or sell the stock, and investors are advised to do their own research and consult with their financial advisor before making any investment decisions.